Okay, it is 11:04, so we're going to go ahead and get started. Before we begin, please follow the instructions on screen, and I'm going to go ahead and go to that next screen for you all. This is to join Conferences IO for polling. By scanning the QR code on screen with your phone, you will need to participate in these polls in order to gain those CPE credits. You will also need to attend for a minimum of 50 minutes, answer the majority of those poll questions to receive the CPE credit. Within one business day of the course concluding, you'll receive an email from certificates@conferences.io, and that includes your CPE certificate. All of these instructions have also been dropped into the chat. If anyone has any questions about their CPE certificate, they can email training@saxadvisorygroup.com. Again, that email is also in the chat. Just a few housekeeping notes as we go through this presentation today. The session is being recorded. The webinar replay will be available shortly after the session. All attendee cameras and microphones will remain off during the webinar. If you have any questions, please submit them at any time. You can just utilize the chat, and it is 11:05. So without further ado, I'm going to pass it over to Ladidas, and she is going to be our moderator for the morning. And there you are, Ladidas. Take us away.
Thank you, Imani. Much appreciated. Good morning, everyone. My name is Ladidas Lumpkins, and I'm a tax partner at Saks, where I head our trust and estate practice. I focus on trust, estate, and gift tax planning and compliance for private clients, both domestic and cross-border, and their closely held businesses. Welcome, and here's what we have planned for today's session. We're going to hear from 4 of our Saks tax leaders covering year-end planning for individuals, key strategies for businesses, the current state of the IRS, and also opportunity zone planning. Each presentation will be followed by a poll question. Those will pop up directly on your screen, so remember to answer those. And with that, let's get started. Our first speaker is Lou Calamunci, and he's going to talk about year-end tax planning for individuals. Lou is a tax director at Saks, and he's going to share with you key strategies to help you optimize your tax position before the year end. Lou, the floor is yours.
Awesome. Thank you. And thanks everyone for joining. And like you said, we're going to go through cover a couple things with the One Big Beautiful Bill as it pertains to 2025 and year-end planning. And then last slide that I'm going to go over is just some tax tips to save some tax dollars before the end of the year. So first up, the tax rates stay the same, and they were permanently extended through the One Big Beautiful Tax Bills, ranging from 10% all the way through 37%. In 2026, they were set to go back to 39.6%. But they're going to stay at that with the new bill that was passed in the summer. Or your 2025 standard deductions for single and married filing separately is $15,750. For married filing joint is $31,500. And then just for the max tax rates, a married filing joint to get to the 37% rate, it's your income above $751,600, and single it's going to be $626,350. After that, you'll be taxed at the 37% tax rate. So next slide. Next up, this is one of the big things that passed in the bill was the SALT deduction. It was previously limited to $10,000. Starting in 2025 through 2029. There you can get up to $40,000 of SALT deduction if your income is below $500,000. There is a phase out between $500,000 and $600,000 at 30%. So that's key for year-end planning. If your income is below that $500,000, you want to make sure you're making your Q4 estimated tax payments before the year end, and really visiting that stuff and stuff like that. And then for married filing separate, it's $20,000, and this is going to get adjusted each year for inflation. So next year, the max SALT deduction is $40,400. And then there's a quick example. If your income is $550,000, you're $50,000 above the max threshold. and there's a 30% phase out. So your SALT deduction for 2025 would be $25,000. And just keep in mind, it does not go below $10,000 is the lowest your SALT deduction will be for 2025. Next slide. So this was something that was when they're discussing the bills and the drafts and the different versions of it, they were talking about phasing this out and stuff like that. But the excess business loss is permanent, and it was in the one big beautiful bill. So the max loss for a current year loss in 2025 that you could take is 626,000 for a joint married filing jointly, and 313,000 for a single taxpayer. So if you have losses above those numbers, they are disallowed or suspended in this year, and they carry over as an NOL to the next tax year. So, and then where you could use 80% of that. So keep that in mind when you're doing some year-end tax planning. If you have a current year loss above those numbers, you may not be able to take the full loss and stuff like this. It's definitely something you should discuss with your tax professional. Okay, so next up is the no tax on tip. No tax on tip. I'm sorry, no tax on overtime. There's a lot out there on that. So a couple things. So you can get a deduction up to 12,500 for single, or 25,000 for married filing joint on your overtime pay. There's phase outs above 150,000 for single, or 300,000 for married filing joint. Keep in mind the overtime is not, if you're making $20 an hour, your overtime rate is $30 an hour. Only the $10 an hour you'll get the deduction for, not the full $30. And then it's still subject to payroll and employment tax and stuff like that. And this is effective as of 2025 through 2028. At the end of 2028, this sunsets. And you really have to follow the Fair Labor Standards, the FLSA, for the guidelines and stuff like that. There are some states where if you work more than 8 hours in a day, you get overtime. That does not qualify. This is really just over 40 hours for the work week. And there is some guidance. The IRS issued notice 2025-69 with guidance on this. So there's really no straight reporting as it's going to report on your W-2 this year. So you're really going to rely on your last pay stub and stuff to break this out. So next up was another big one, no tax on tips. This is effective for 2025 through 2028. So the IRS came out with about 70 jobs that qualify for this. So you guys should really look at that. Hairdressers, servers, bartenders all qualify. There are some self-employed individuals such as rideshare drivers and stuff like that will also qualify for this. So they could get a deduction of 12,500 for single, or 25,000 for a joint taxpayer. And then that's another thing. Look at the Treasury guidelines to see if you qualify and stuff. And there's really on the W-2, there's not going to be a line on it that says where your tips are, but typically box 7 of your W-2 does show your taxable tips. So that's a starting point and stuff like that. And both these are above the line deductions where you do not need to itemize to take them. Next up is no tax on car loans. So this is if you purchase a car, this is for 2025 going forward. It's a new vehicle. You could deduct up to $10,000 of the interest that you paid on that. There are phase outs, so over 100,000 for single and 200,000 for joint taxpayers filings. It will phase out your deduction. It's for qualified interest on new cars. So keep in mind, used cars do not qualify for this. And there are provisions. It has to be for personal use. So if it's a business vehicle, it does not qualify for this. That would get deducted on the business return. This is as well as above the line deduction where you don't have to itemize to take this. So it's available for non-itemizing taxpayers. And the key thing here is the final assembly has to be in the United States. There is a website that you could use to look it up. You put in your VIN number of the car, and it's going to tell you if it was final assembly in the United States. Just don't assume because it's a Ford or a Chevy that was necessarily assembled or final assembly in the United States. Some of those cars are assembled in Mexico and stuff like that. And then there's some, it has to be 14,000 pounds or less and stuff like that. So really look at the guidelines on that. Next up is the senior deduction, or no tax on Social Security. It's really, Social Security is still taxable. This is just a deduction for seniors. So if you're above the age of 65, you will get a $6,000 deduction, up to $12,000 if you're filing a joint tax return. And the income phase outs are 75,000 for single, 150,000 for joint. And this one does end at 12/31/2028. So for the next 3 years, 4 years, you could take this deduction, and it is retroactive to January 1, 2025. A couple other additional things that were in the one big beautiful bill, charitable contributions. So if you do not itemize, you could still get a benefit for making charitable contributions. For single, it's $1,000, and married filing joint, it's $2,000. So it's going to be above the aligned deduction, so it's not going to go on Schedule A. So there are some benefits for non-itemizers to make charitable contributions prior to the end of the year. Also, itemized deductions, a couple of things were phased out. Nothing really changed this year. It's just for the expiration of the Tax Cuts and Jobs Act. There are no miscellaneous 2% deductions any longer. Another big thing is 2026 on, there is going to be limitations to your total itemized deductions for high income taxpayers. So if you are planning a big charitable event, you may want to think about doing that in 2025 as opposed to 2026. You may not be entitled to the full benefit, and it may be phased out between about 2 to 3% of that, where you're not getting the full benefit of that. Another thing is the mortgage interest deduction. It is still limited to your debt of $750,000. So if you have mortgage interest debt of above 750, it is limited based off of percentages and ratios. So that, as well as what's new for this year, is mortgage insurance premiums are deductible for 2025. So that's something that has not been deductible in the past couple of years. A couple other things, the child tax credit, that was permanently increased with the one big beautiful bill. It's going to be $2,200 per child starting in 2025. And there are thresholds on that, $200,000 for single and $400,000 for married filing joint for the full amount. Above that, there are phase outs and stuff like that. Another thing, qualified business income deduction, QBI, that's going to remain at 20%, and that was extended permanently. So that's something just to be on the lookout prior to year end to make sure you're in line to get the full deduction on that. Here's another big talking point here, the Trump accounts. There hasn't been much put out about these as far as how to set them up and stuff. But you are allowed to deposit $5,000 into your children or guardian's account per year until they're 18. They are going to get a one-time $1,000 credit for newborns between 2020, if you're born in 2025 through 2028. If you make contributions, they are not deductible. And once they turn 18, this is going to be treated as like an IRA and they're going to follow more or less those withdrawal rules and the taxabilities of those. There's some talk about how it gets reported and stuff and how you do it for 2025. The IRS hasn't really said much about that. I'm hoping that they come out with some guidelines before the end of the year. But we will keep you posted on that. As soon as we hear something, we'll put something out for you. Next up is just the energy credits and the clean vehicle credits. So most of the energy credits are going to be repealed by the end of the year. So if you're thinking about doing home improvements and stuff that qualify, you may want to do it for the end of the year to get the credit, as well as the clean vehicle credits for the electric cars. As of September 30th of this year, they're no longer offering the $7,500 credit on that for the Teslas and all those cars and stuff like that. So I want to touch on gift tax. So the lifetime state and gift tax exemption is going to remain, or it's going to be at the adjusted amount is set to go back to between $6 and $7 million at the end of this year, starting next year. But the one big beautiful bill, they permanently extended that. And this year, your exclusion amount is 13,990,000, or your annual exclusion of 19,000 that you could give, or 38,000 if you're gift splitting. So keep that in mind for year-end planning and gift taxes and stuff like that. And also Ladidas is on the line, which if you have any questions, reach out to her. She's all things trust and estates. All right, and then here are just some quick tips for the end of the year to think about prior to the year end, because once the year end, it's hard to go back and plan and stuff like that. So if you have realized gains, you may want to think about harvesting stock losses. Just keep in mind the wash sale rules. In 30 days, you have to wait 31 days to repurchase it. If you do that, the SALT deduction that we discussed earlier, make sure you're maxing out on that or paying your Q4 before the end of the year for your state income taxes. Possibly accelerate your last mortgage payment to pay it before the end of the year, not on January 1st, so you get the deduction this year as opposed to next year. Maximizing your retirement plan contributions, such as your 401k, making sure that's maxed out and stuff like that. Charitable donations, obviously make those before the end of the year. Depending on your income levels next year, they may be limited with your itemized deductions, as well as your qualified business income deduction, QBI. Make sure you're getting the full 20% on your trade or business, and that you're not limited, so that your W-2 wages are in line with what they need to be in your UBIA and stuff like that. Also, I don't have in your RMDs, so make sure you take your RMDs prior to the year end. And that's it for me. I'm just going to leave off here with a poll. Will the one big beautiful bill increase your tax, decrease your tax, or not sure? The poll in question should pop up on your end.
And I see some votes coming in. Thank you all so much for participating in the polls. And we're just going to let this count down until we get to 0, and you guys will be able to see those results.
Lou, with your finger on the pulse of clients, how would they answer this as the results of the audience is coming in? What's your impression?
I think most people are going to see a decrease, if not stay the same. I don't think there's really any situations where they're going to be increased. There are some AMT adjustments and stuff like that. But I think most taxpayers are going to either stay the same or have a decrease.
Right, and it looks like a lot of people did vote for decrease, and we will move right along. Thank you all.
Thank you, Lou, for that presentation. And we're going to transition to key strategies for businesses. And next we have Mayank Shah, who is a tax director at Saks. And he's going to talk us through some strategies highlighting tax law changes recently enacted with the One Big Beautiful Bill Act, OB3, much easier to say, and provide us with some actionable approaches for optimizing business tax positions before the year end. So, Mayank, take it from here.
Thank you, Ladidas. Good morning to all of you who are attending today. So I'll be going through some of the business tax opportunities within the One Big Beautiful Bill. Some of the provisions that we will be going over today are bonus depreciation, Section 179 increases, research and development credits, some information surrounding QBI, which Lou has already discussed, business interest expense limitations, some business meal deductions updates, as well as some ERC and QSBS, qualified business stock, qualified small business stocks, and tips and overtime in terms of employers, and a couple of other small provisions. So with that, one of the biggest item that was changed with the OBBB was that 100% bonus came back. As you guys know, until the bonus appreciation was kind of gradually fading away or phased out over the, I guess, previous 5 years. In 2025, it was at 40%. But with the new bill, the bonus appreciation goes back to 100%. And that is for any property that was acquired and placed in service after January 19, 2025. Next. So some more information on bonus appreciation. The bill also introduced that any any qualified production property will also be eligible for 100% bonus, right? There are some tests that they'll have to go through. Number one, it should be a commercial property placed in service within the U.S. Has to be a manufacturing facility, and that there are some other tests, such as qualified use. The facility must be exclusively deployed in qualified production activities. It excludes administration, sales, R&D, and other various non-production usage. Those would be excluded, and the property will not qualify for it. One of the other things that you should keep in mind is that the product that has been developed in this facility has to be substantially transformed from the point or the from the point of the production to the end. The construction of the facility must begin between January 19, 2025 to January 1st, 2029, and placed in service before the January 1st, 2031. Acquired property must be purchased between January 1, 2021 and May 12, 2025. It does not apply to the lessor. And depreciation recapture if property use changes within the 10 years of place in service. This opportunity also provides enhanced value of the cost segregation studies. So always keep that in mind. If you have a new facility placed in service or coming up online, let's see if we can make use of the cost segregation and expedite those deductions. Something related to depreciation, Section 179 deduction, that limit has been increased to $2.5 million, and the phased out threshold is also increased to $4 million. And these amounts will be adjusted for inflation going forward. Next. Next up on the list is R&D credits. As you guys know, TCJA back in 2022 required capitalization of R&D expenditures, and they would be amortized over 60 months if they were within the US and 15 years for any R&D taken place overseas. With OBB, that has changed. Small businesses under Section 448C may amend 2022 to 2024 tax returns to expense R&D, and there is a deadline from the enactment of the bill, which is January 4th, 2025. So that gives you until July 4th, 2026. There is a special election available to reduce the R&D credits in lieu of non-deductible treatment of the credit. Can you guys still hear me? Okay. All taxpayers may deduct remaining R&D expenses for 2022 to 2024 over 1 or 2 year period. R&D expenditures reduced by R&D credits only after 12/31/24, and it does not apply retroactively. Next. Next up on the list is the QBI. I believe Lou already discussed, but just to reiterate that, OB3 makes the QBI permanent going forward. It has increased the phase-in income limitation ranges for single and merit filing joint filers. minimum $400 deduction for businesses with at least $1,000 of net income plus the active QBI for 2026. Next. Next up on the list is the business interest deduction limitations. With introduction of TCJA, there was a 30% limitation on EBITDA, and then it was reduced to take out the depreciation from the calculation, and disallowed interest was carried forward. With OB3, ATI brings in the EBITDA back into the play, and also expands floor plan interest to include trailers and campers. This is in effect for the tax years beginning after 12/31/24. Just going forward, effective for tax years beginning 12/31/25, interest limitation includes capitalized interest. This is basically the interest that was previously allowed to capitalize to the inventory, right? That is going to be disallowed going forward, with exception for certain capitalized interest under Code Section 263G, which is straddle contracts, and the other one is for the self-constructed assets. ATI will also exclude subpart F income, net CFC, tested income inclusions, and Section 78 gross subs from the ATI. Next. Next up on the list is the business meal deduction. There's not a lot of change here, but there is a caveat to that, is that OB3 now allows 100% deductions for meals provided at the convenience of the employer if the expense relate to the goods or services sold for an adequate and full consideration, right? So think of this as employees of a restaurant, and the employer provides before and after meals from their shift. And the other one is it provides 100% deductions for food or beverages provided to crew members of certain commercial vessels, oil and gas rigs, fishing vessels, and other processing facilities. Just a quick update on the ERC. It retroactively terminated for taxpayers who file refund claims after January 31, 2024. The IRS has increased the enforcement, higher penalties for ERC promoters, and statute of limitation has also extended to 6 years. Next. Qualified small business stocks. So the current law provided that the stocks are listed or owned for more than 5 years. It provides exclusions based on the date of stock acquired. However, OB3 updated this the holding period and the exclusions allowed. So it says basically if the stock's held for 3 years, you get 50% exclusion. 4 years, it bumps up to 75, and 5+, it goes to 100%, right? And it also increased the limit on the corporation's assets at the time of the stock issuance from 50 million to 75 million. So there's always an opportunity here if you're a growing business. Next. No tax on tips and overtime. This was discussed by Lou, but from an employer's standpoint, there was some guidance issued on September 19th surrounding the list of occupations, and also I believe ours just came up with some more guidance last Friday. And just keep a note that there will be some more guidance available or will come out in the future as well. However, the IRS will provide a transition relief for tax year 2025 for taxpayers claiming the deductions and for employers and payers subject to the new reporting requirement. Paid family leave, paid family and medical leave credit. OB3 permanently extends the credit, can elect to claim wages or insurance premiums that cover paid and family leave for employees. Control group rules apply in this case. All members must have written policies. So if you have a group of companies, they all should have written policies in place for you to qualify. Employer provided paid leaves required by the state or local government would count towards the paid leave provided by the employer for the purposes of determining eligibility for the credit, not the amount of credit. Next. Which is the employer provided child care credit. OB3 also increases the credit to $500,000 and up to $600,000 for eligible small businesses. Increases the credit percentage from 25 to 40% and also 50% for the small businesses. This is effective for the tax years after 12/31/25. Eligible small businesses must meet the gross receipts test for a 5-year prior period. It also expands the definitions of childcare expenditures and qualified childcare facilities. Last but not least, this is going to reduce so much of burdens if you have employees or third-party contractors who you pay less than $600, right? So effective tax years after 12/31/25, that threshold from 600 goes up to 2,000. Also, the 1099K reporting, the OB3 reinstates the pre-ARPA threshold, which was 20,000 in receipts and 200 transactions. So for 2025, I think we're still at 600, but from next year, it's going to go up to $2,000. Okay. Question, what is the new reporting threshold for total payment to a contractor that triggers the requirement to file a Form 1099 NEC, starting with the payments made in 26? We're not talking about 25 in this case, which has not been changed. So the options are 600, which is no change, B 1,000, C 2,000, and D 5,000.
Mayank, in your experience, what are you hearing from clients in terms of all of these changes? What's going to be most impactful to them?
I think the bonus appreciation, definitely the biggest one, and also changes to the business interest expense limitation. So since the depreciation came back, I think that's going to give clients a little more wiggle room to utilize the interest expenses going forward.
Excellent.
And our results are in. It looks like 63% of you voted for $2,000 in that poll.
Yep. D is
And
the
we
right
have
hand, $3,000. Thank you all.
Thank you very much,
I-
Mayank. And we've got Matt Giordano, who is a partner at Sachs and head of our tax controversy practice. And he's going to talk about the IRS state of affairs, which has been changing almost, it seems, on a daily basis. So he'll get us all up to speed in terms of what we can expect in interacting with the IRS, including what has happened recently with the workforce reduction and the impact of the recent IRS shutdown. So Matt, over to you.
Yes, thank you, Ladidas. And when we originally planned this presentation, the government was shut down. And so that was going to be the primary focus, but it's since opened back up. And so we figured it would be a good idea to give everybody an overall state of affairs of the IRS, factoring in what took place earlier this year with the workforce reductions and then the more recent government shutdown. So that's what we're going to talk about today. Okay. All right. So let's kind of take a look at, where we were here. And really what we were looking at is a decade-long retraction of the IRS from 2010 to 2020. So in 2010, the IRS had approximately 12.5 billion in appropriations. If you adjust that for inflation to 2020, you're looking at about 14 billion. And in 2020, the IRS only had 11.5 billion in appropriations, and that's not accounting for inflation. So that's a billion less from where they were in 2010. Just looking at the pure numbers here, and this was actually a continuation of a 20-year decline in IRS funding, but you started to see it get really bad in that decade from 2010 to 2020 for various reasons. And from a staffing perspective, 2010 they had about 95,000 full-time equivalents. And in 2020, it had closer to about 76,000 full-time equivalents, which represents a 20% drop. All right, next slide. Okay, so we know where we were. I like to use the analogy of classic cars for two reasons. One, I'm a big classic car guy, and two, it's going to kind of highlight what the government was trying to do with the IRS, with the additional funds that they were supposed to be receiving. So you saw that Volkswagen bus was pretty beat up and pretty rough shape. And so, what we saw was audit rates plummeting. In 2010, high income taxpayers had about a 16% audit rate. 2020, that dropped to 2%. And on the technology and service side, it's really bad. They're relying on decades old technology. Some of their systems date back to the late 60s, which is LBJ and Nixon era. That's not a joke. That's not a typo. That's for real. They're just, patchwork upon patchwork getting put on top of old technology to keep it moving. And but by 2020, fewer than 25% of taxpayer phone calls were answered, which is just not acceptable for a country like ours to service its taxpayers that way. All right, next slide. And really, what this results in is a workforce sustainability crisis. You had an aging workforce, 40 to 50% near a past retirement, and while that was happening, they had a freeze in hiring. So you didn't have the younger employees coming in at the sufficient rate to replace the retirees, and so you lose a lot of valuable institutional knowledge in an environment like that, and just skill gaps between technology and enforcement with the younger agents not coming in. Okay. So then, where we were headed, um, 79.4 billion was supposed to come through the Inflation Reduction Act of 22, supposed to be allocated to the IRS over a 10-year period. The primary purpose of these funds were aimed at restoring and enhancing the IRS over a long-term period. And really, this was to bring the agency into the future and to kind of restore it back to where it was. I thought there was a slide that showed a restored Volkswagen bus, but I think we might have skipped over it, but that's okay. Oh, there it is. Okay, great. All right. Thanks. All right. All right. So I want to focus on the 79.4 billion. And the number I really want everyone to look at and focus on is the $45.6 billion number that was supposed to be dedicated towards enforcement out of the 79.4. And this was to hire agents and increase audits. And again, it was really just to get the IRS kind of back to where it was before they had that significant retraction in funding. I know there was a lot of, there was some terrible misinformation out there that they were going to be hiring 80,000 agents with guns going door to door on people. That was just comical misinformation. That's really not what they were doing. Yeah, I'm sure they were going to hire some additional agents into criminal investigations, which yes, they do carry guns, but there were not going to be 80,000 IRS agents hired carrying guns around. That was not going to happen. All right, next slide. All right, so that 79.4 million billion, big detour ahead. We'll see the slashes that were made to that on the next slide. And so June of 2023, 1.4 billion got cut. March of 2024, 20.2 billion got cut. And in March of 2025, another 20.2 billion got cut. And these are numbers straight off the US TIGTA, Treasury Inspector General for Tax Administration. Next slide. All right, so that leaves the IRS with about 37.6 billion of the original 79.4 billion. Why does this matter? We'll see on one of the next slides that all three cuts disproportionately hit the enforcement category instead of other areas of that budget allocation. So this weakens the IRS's ability to pursue non-compliant and fraudulent taxpayers, and it also reduces the effectiveness of the IRS's long-term mission of closing the significant tax gap between what people should pay in taxes versus what the IRS ultimately collects, which is roughly $600 billion. It's that type of a significant reduction to enforcement is not going to help that number at all. Okay, next. And so yeah, so here we go. So this is how the remaining 37.6 billion is being allocated. And the number I want everyone to focus on this slide is that $3.8 billion number. Because as we'll see, I'm going to repeat a slide that I showed earlier just to highlight. So 3.8 billion for enforcement of the 37.6. Go to the next slide, please. The original amount that was anticipated was 45.6 billion. So massive slashes to IRS enforcement with those reductions to the original $79.4 billion that they were supposed to receive. Okay, next. All right, so where are we now? And we're going to talk about that and where we are now from those workforce reductions, and then get into the shutdown conversation in a bit. Heading into 25, IRS had about 100,000 full-time equivalents. 7,000 probationary employees were laid off in February. That represented 7% of the overall IRS workforce. A lot of them were very close to that year mark. Some of them had just finished up their upfront training and were going to beginning, they were about to start working examinations, which is what they were hired for, and then the money spent on training them. And a lot of them, 7,000 were terminated. Then 4,700 employees took the first round buyout offers in early March. And then 22,000 employees tried to take the second round buyout in April. Not all were approved, though. Okay, next. All right. This ended up leaving the IRS with somewhere between 65 to 70,000 full-time equivalents. Again, enforcement did take the biggest hit. So the overall reduction was 7%, but IRS enforcement ended up seeing a reduction of about 25% in their two main enforcement areas, LB&I and SBSC. They did underestimate how many employees were going to try to take advantage of the buyout. They ended up denying a bunch, and they actually did try to bring back some probationary employees because they just kind of lost too many people too quickly in a short amount of time. So, like, my understanding is they're back up to around 75,000 full-time equivalents, give or take. It's hard to really pinpoint that exactly. Okay, next. All right, so walking into the unknown. Let's kind of talk about what we're probably going to be dealing with a bit. Examinations are likely to slow down for now, right? If you just follow the law numbers, the same level of enforcement is just not possible with such a significantly reduced workforce. Even if you factor in some of the advancements they're trying to make in technology, you're just not going to see examinations conducting at the same rate that they were. We already experienced some examinations of various sizes getting shut down, no changes at the various stages, mostly very early on. There was a better chance of it getting shut down, and it just depended on whether the examining agent was one of the agents who was terminated or took the buyout. So multiple factors on that. Okay, next. Notices will become more common, more difficult to resolve, right? If you don't have enough humans at the IRS supervising the notice process, the computer programs are just going to run wild while responses to notices sit stagnant. And yeah, that could be a problem for certain notices that don't come with appeals rights. Your only option could be U.S. tax court after that, and it's not where you want to be. And just taxpayers will be angry and frustrated, similar to what we saw with COVID. Okay, next. And delayed refund processing, long hold times for phone support, which we already have, backlog and correspondence, delayed identity verification, things like that. Next. All right, now we'll move into the shutdown. The government was shut down for 43 days from October 1st to November 12th. IRS did have some contingency funding to run for another 5 business days. That ended October 6th, and then they had to shut down like everyone else, and they had to furlough non-essential employees until the government opened back up. Next. And I think the results here are going to be similar to what we were talking about earlier with the workforce reductions. We're going to see delayed processing delays, reduced customer service, delayed refunds. We're in delayed processing of payments. We're seeing issues where people sent payments in with returns and they're getting notices that they still owe the money because there's just delays on everything going on over there. And then also delays for tax related guidance, right? Like a big focus of this conversation was the one big beautiful bill. Um, its regulations will be delayed because of the shutdown. Next. All right, these are my last two slides here. Um, Public service announcement. It's not coming in too clear. These next two slides are supposed to cover theft, identity theft, tax related ID theft, and just overall theft and scams. On the IRS side, if there's tax ID theft, somebody tries to file a return on your behalf, it's taking the IRS a very long time to resolve those cases. Resolution 20 cases resolved in 24 took 676 days to be resolved. That's over two years. Somebody could be waiting to get their refund released for an ID theft case. And then there's no individual protection pins issued during the resolution. So you're stuck paper filing returns until the matter is resolved with the IRS. Okay, next. Okay, and then just overall, we're seeing an overall rise in theft, ID theft and financial scams. People really need to be careful about the types of things that they're doing on phone calls or on their computers. There could be some very nasty tax results that result where um, we're seeing situations where if a 401k account gets wiped out, that could trigger a 1099-R distribution, which you have to report to the IRS because it's reported to them on the 1099-R, and then you're stuck trying to figure out how to remove that income or how to take deductions. And there's very, limited rules on the types of deductions you could take in these types of situations. As a result of the Tax Cuts and Jobs Act that was passed in 2018 and some of the changes that were made there. So that's just something for everybody to keep an eye on. This is our public service announcement for the day. And that's it for me, I believe.
Thank you, Matt. Perfect.
Which of the following services are offered by Sachs Advisory Group? I believe the options were tax, accounting and attestation, wealth management, fractional financing, outsourced CFO, and client accounting services. And all of the above, I believe was the last answer.
And Matt, with your discussion regarding the limited resources that the IRS now has, where do you think that they're going to focus their attention?
So it's difficult to say. I think right now, employee retention credit is still very hot ticket item for them.
Eddie Rivera, who's going to talk to us about opportunity zone planning. And he's got about 5 minutes to do that, but I'm confident that he's going to bring us home. And Eddie is a partner with Sachs in our real estate and construction practice. Eddie, the floor is yours.
Thank you, Ladidas. Good morning to everybody. Thank you for joining us. I've got 5 minutes, so apologize if I talk very, very fast here. I'm gonna go. Let's skip the next slide. Yep, we don't need to know anything about me. Yep. So today, the plan is to cover the following summary of the Tax Cuts and Jobs Act Opportunity Zone rules, which were in effect from 2018 to 2026. We call that version one. Second point, tax planning for OZ law, V1 sunset. We're going to talk about things you can do right now to prepare for the next 13 months and the sunset of the law. And then lastly, we're going to go through a summary of some of the changes that the One Big Beautiful Bill Act, some of the changes that OB3 made to the Opportunity Zone rules. Next slide. So just, remembering what the goal of the program was, the incentive of the opportunity zone, or the incentive's purpose, was to spur economic development and job creation in distressed communities by providing tax benefits to investors. Some people would say that you would pair this type of investment with impact investing. Some people would call this a form of impact investing. At the end of the day, the goal was to give people benefits, to make them want to give back and to redevelop areas that were in need of it. Next slide. As part of those incentives, the benefits that were available to you were tax deferral for gains realized and invested in a QOZF between 2018 and 2026. There were tax deferrals on gains recognized. Those tax deferrals for the gains recognized in earlier years would ultimately be recognized in 2026. So if you sold Apple stock in 2018, you invested in an opportunity zone in 2019 or 2020. Now, as long as you held the investment in the QOZF for the Qualified Opportunity Zone Fund, and there was not an inclusion event, that gain would ultimately be picked up in 2026. There were also a couple other benefits. The basis step up of 10 and 15% for QOZF investments held for 5 and 7 years. And then lastly, the main benefit was that you would get a basis step up in your investment in the QOZF to the fair market value of that investment after 10 years of holding the QOZF. So amazing benefit. If you held the QOZF for 10 years, you could sell it after the 10-year mark and not pay any federal income tax dollars on it. Next slide. Just some things to think about. Sunset planning. There's a mandatory inclusion of gain on December 31st, 2026. If there was not a sooner inclusion event in 2025 or prior, you will pay tax on the original gain that you used to defer into a QOZF. That gain will be deemed to be recognized on December 31st, 2026. The inclusion of gain, and this is probably the most important point for everyone out there, the inclusion of the gain is limited to the lower of the fair market value or the deferred gain that you should have reported annually on your 8997 form. Please note that the fair market value of the Qualified Opportunity Zone Fund investment is measured on December 31st, 2026. And what that means is if I am invested in ABC QOZF LLC, then if I think that the valuation of that investment is lower than the actual gain that I previously deferred, I'm allowed to use that fair market value of the investment if it is lower than my actual investment that I made or deferred. This requires appraisals, and you need to have certified appraisals that will pass IRS muster. I think from now until December 31st, 2026, everyone should be monitoring their value in their Qualified Opportunity Zone Fund investment. I think if you think that the value is lower than your original investment, you should be planning for appraisals of the assets and the valuations of the QOZF investment. And lastly, I think you need to be focused on making sure that your CPA, whether it was Saks or some other firm, properly and annually filed the 8996 and 8997 for you. Next slide. Case study one, very quickly. You sell Apple stock on December 31st, 2019. You have $1 million gain. When 2026 comes around, you have to figure out what gain you're going to recognize in your 2026 tax return. First, you have to compute the gain without regard to the fair market value of the investment. So it would be $1 million in Apple stock sale gain. Because you held the QOZF investment for 7 years, you would get a 15% reduction. And so your gain would be $850,000. If the fair market value of the capital interest in the QOZF was 1.8 million, then you're going to end up paying paying tax on the gain, which is recognized in the lower of the investment, which is $1 million less the special basis adjustment, or the 1.8. You can see in this case, you're just going to pay tax on your original gain minus the basis adjustment that they gave you. Next slide. Case study two, I like to remind people that this is not a dead zone for opportunity zone purposes. A lot of people think because you have a gain in 25, there's no benefit to investing in 2025. I'm trying to explain to people and remind people that if you have $1 million gain of Apple stock sometime in 2025, when you go to recognize the gain in 2026, first you have to compute the gain without regard to the fair market value of the QOZF investment, which would be you're allowed to use minority and control discounts. And so maybe that $1 million gain that you incurred in 25, if invested in a QOZF, is perhaps a $700,000 gain after discounts. And so you would recognize the gain on the lower of $1 million deferred gain, or 700,000. Next. So let's talk about the One Big Beautiful Bill Act, 2027 and OZ version 2. Some changes. There's going to be a rolling 5-year 10% basis step up. So every time you have a gain, every time you have a gain and you defer the gain into an opportunity zone fund, if you hold the fund for 5 years, you'll get a 10% basis step up for the tax deferred gain. And that begins 1/1/27. There'll be a 30% basis step up for what they call rural areas. I don't want anybody to think that the rural areas will not qualify for them. Rural areas are not as rural as I don't think are as rural as they were meant to be. There's some population eligibility rules there. I believe 50,000 population in the area is one of the rules. Doesn't seem that rural to me if there's 50,000 people living in the area. But please review those rules, or ask Sachs or your CPA to review those rules. And then lastly, the tax deferred gain is recognized on the 5th anniversary of the investment date. Next slide. Some other changes. There's a 10-year rolling designation period. So every 10 years, the governors of the states where the opportunity zones are designated, they need to basically every 10 years update those census tract designations. There is stricter census tract eligibility with regard to demographics testing, income testing, things like that. So it's going to be a little harder to designate a census tract. There are new reporting requirements and larger penalties, stiffer penalties for not following those reporting requirements. And lastly, there's a limit that you must pay taxes. You must recognize the gain, sell the QOZF. And if you don't sell the QOZF after 30 years, there will be a required recognition of the gain that was deferred. Next slide. That should be it, correct? I believe the polling question is next.
It is. So our final polling question will go up next, and I'm going to send that through now.
And as I said, I apologize. I know I spoke with a sense of urgency there. I want to make sure everybody that has their 12 o'clock lunch appointments gets to their lunch appointments.
Eddie, you did great. We started at 4 minutes after, so great job getting us to the end here. And thank you to all of our speakers, Lou and Matt and Mayank, and of course to our audience for joining us